With housing affordability under pressure and rental demand continuing to rise, investors are paying close attention to the build to rent sector. So, what's driving growth right now? Today, we're looking at Grainger's latest results and how its rental platform is positioning the business for long term returns. I'm joined by Kurt Mueller, Head of Investor Relations at Grainger plc. Kurt, welcome to the watch list.
Ricky, thank you very much. Thank you for having me. And apologies, I'm fighting the tail end of a cold, but hopefully all your listeners can hear what I have to say.
Well, we've all been there, so don't worry about it. But on the good news, positive side of things, congratulations on your latest result. Can you walk us through some of the standout performances from the first half of the year?
Absolutely, Ricky. Well, it's been a really strong first half of performance for us, and that's across the business. Um, we've also had an excellent earnings outlook for the years ahead, which I'll talk you through in a minute. And all of that is despite the operating in quite uncertain global and market conditions that I'm sure everyone's familiar with. So what we've seen over the first half is net rental income has gone up by nearly 8%. Our earnings have gone up 4% on a net per basis, and our occupancy across our national portfolio of over 11,000 properties is about 96%. Our rents grew by 3.1% on a like-for-like basis. And importantly, we remain on track for that guidance I talked about on our earnings growth. We expect to grow earnings by 12% this year from last year and by 35% to 2029. So all in large, a strong first half for us.
And a major theme amongst those results appears to be continued strength in rental demand, kind of similar to what you just mentioned there. What's driving that ongoing growth in rental income and occupancy across the portfolio?
Well, the UK is structurally undersupplied in its housing market. And as you mentioned earlier, demand for renting and housing generally continues to grow. The population continues to grow as well. Most recently, we've also seen a reduction in the supply of rental housing as small landlords continue to sell their properties, partly due to regulation, partly due to taxation. Um, so that is all underpinning our continued rental growth. And there's three main drivers in that like for like rental growth, that organic growth that I talked about of over 3% that we've seen across the portfolio across the period. We also are expanding our portfolio. We've got a pipeline of committed development projects, which we are building out. And part of that growth is the lease-up of those recent developments, which added a £5.7 million of net rent over the first half. And then thirdly is that demand, the fundamentals in demand remain very, very supportive. So that occupancy is high, which is driving the rental growth, and our customer affordability is still really healthy. So on average, our customers pay 27% of their gross income on rent, which is very below the market average. And that's actually improved over the period as well, which underpins our pricing and our retention. So it's a combination of that organic rental growth, income from the pipeline, and consistent, strong customer demand.
Another angle as well is this institutional interest in rental housing. And as that continues to grow, scale and operational execution become increasingly important. So, what are the key strengths of Grainger's platform and portfolio that position the business for sustainable returns over the coming years?
Again, a great question. And for those that don't know Grainger, we are sort of a one-stop shop for rental housing in the UK. So we are originators, developers of our own buildings. We are the owners of those buildings, and we are the operators of those buildings. So if you go to Grainger's website or to Rightmove and you find one of our properties and you register your interest, you'll do a viewing with a Grainger colleague of mine. If you move in, it'll be a Grainger colleague of mine who's on that front desk saying good morning to you every time you go off to work in the mornings. So that's one of the strengths and the data that we know about our customers, what they like, what they want, what works for them, what doesn't work for them, is data that allows us to provide increasingly better customer service. And our platform is tech enabled. So all that data and now plugging in AI allows us to really target better customer service, better value, and better performance across our portfolio. So housing is a needs-based asset class. Unlike other real estate asset classes, everyone's always going to need a place to live. So from that perspective, we're AI resilient. Computers are not going to replace the need for us to sleep somewhere every night. And indeed, it's quite an upside for our business because of all that technology and data that we have. AI is actually helping our business run more efficiently and provide better service to our customers. So Our rental income is underpinned as well by wage inflation. As wages increase, our ability to increase rents and of people's affordability remains static. So that's a real underpin for our continued growth, which is again quite different from other real estate types. We have a diversified and growing customer base. Our customers are diverse across the employment sectors they work in. They're diverse in their age, right? 85% of our customers are over the age of 25. And our customers we have a very limited exposure to the student market, which is softening in certain parts of the UK. Less than 10% of our customer base is students, which is a self-imposed cap. Um, our assets are in great locations in the biggest cities in the UK. We have a deep, involved research process deciding where we want to allocate capital and where we want to build. And our buildings are new, right? Our average age of our buildings are 4.5 years old, and they're all modern. They're all energy efficient. 99.9% of our buildings have energy certificates of either A, B, or C. And with the Iran war and the Middle East crisis, you know, leading to likely energy cost rises, well, our customers could be supported and protected from a lot of those energy costs because of the energy efficient properties. And to that extent, Grainger's own exposure to energy costs is really quite limited. We only have direct energy costs of about £2 million a year. So we're protected from an energy cost exposure perspective. We remain focused in our financial discipline. We have a clear capital allocation strategy. I talked about our committed pipeline driving those earnings, but we also have a clear plan to continue to deleverage the business, reduce net debt, reduce the risk profile of the business. So the UK, to conclude, Grainger is the UK's only listed scaled pure play built to rent platform here. We benefit from a structurally undersupplied market. We have long duration inflation linked income, and we have an excellent earnings outlook.
Wow, so this looks like a business really benefiting from structural demand in rental housing, supported by scale, occupancy strength, and a platform designed for long-term income growth. Thank you so much for your time today, Kurt.
Thank you.
Once again, that is Kurt Mueller, Head of Investor Relations at Grainger plc. For more on the company and its results, visit graingerplc.co.uk. That's all for this episode of The Watch List. I'm Ricky Lee. Make good choices today.